Hi, in this video, I'm going to talk about three leverage ratios: total debt ratio, debt to equity ratio, and equity multiplier. Leverage ratios measure to what extent a company uses debt rather than equity for financing. Also, they measure companies' ability to meet long-term financial obligations. As you see, this is the well-known accounting formula and accounting equation that says total assets that we have should be equal to total amount of liabilities plus total amounts of equity. So as you see in this table that we can find in balance sheet, if we have $5 million of assets, we should have total number of liabilities plus equity that adds up to $5 million, $2 million plus $3 million in this example. So if we know the amounts for two of them, we can calculate the third. Total debt ratio has this formula: total debt over total assets. And in our previous example, we have $2 million total debt over $5 million total assets, that we get 0.4. And it means that 40% of the capital structure is from debt. Debt to equities ratio is total debt over total equity. In our example, $2 million over $3 million, we get 0.67. And it means that for each dollar of equity, we have 67 cents of debt. For equity multiplier, we have total assets over total equity. $5 million over $3 million, and we get 1.67. And it means that for each dollar of equity, we have $1.67 of assets. In another example, if our total debt ratio is, for example, 0.6, we can calculate the other two ratios. So the formula for total debt ratio was total debt over total assets, and we have 60%. So we can write 60 over 100. And we can say our total debt is 60 and total asset is 100. And because we know well-known accounting equation, we can solve for total equity, and we get 40 as total equity. Then we have all numbers, and we can calculate the other two ratios. So the first formula that you see is in our example, and the other two formulas that you see, the other two numbers, 1.5 and 2.5, are debt to equity ratio, and 2.5 is equity multiplier. Thank you.